There is a secret language in the world of finance. It's not spoken in boardrooms or on the frantic floor of the stock exchange. It's a language of numbers, a silent conversation happening on the pages of annual reports, in the lines of a balance sheet that 99% of investors, even seasoned professionals, completely misunderstand. They look at a liability and they see risk. They see a debt that must be paid, a weight pulling the company down. But a select few, the grandmasters of the game, have learned to read between the lines. They look at a certain kind of liability, a very special kind, and they don't see risk. They see a gusher. They see an engine. They see, for all practical purposes, free money. This is the story of the greatest financial secret of the modern era. A concept so powerful it turned a failing textile mill in New England into the most formidable financial fortress the world has ever known. It's a principle that allowed its master, Warren Buffett, to build a fortune of over $100 billion, not by borrowing from banks, but by creating a system where millions of people and thousands of businesses pay him to hold their cash he then uses to buy up the crown jewels of American industry. This isn't about a clever accounting trick. It's about a fundamental shift in perspective, a financial transformation that, once you understand it, will permanently change the way you look at investing, business, and the very nature of money itself. You are about to learn how to identify companies that run on this hidden profit engine, giving them an almost unfair, sustainable advantage in the relentless project of compounding wealth. Forget what you think you know about debt and leverage. We are about to decode the final promise of capital, the art of getting paid to grow. The year is 1967. The world is a kaleidoscope of change. The summer of love is blooming in San Francisco. Sgt. Pepper is on the radio, and the American economy is humming along, seemingly oblivious to the social currents swirling around it. In Omaha, Nebraska, a world away from the cultural zeitgeist, a 36-year-old investor named Warren Buffett is facing a problem, a very serious, very expensive problem. His primary investment vehicle, Berkshire Hathaway, is a ghost. It's a textile manufacturing company, a relic of a bygone New England industry, and it is bleeding cash. Every year, Buffett has to pour more money into the business just to keep it from collapsing. New looms, new equipment, fighting against cheaper labor from the South and overseas. It's a capital-intensive nightmare. Every dollar of profit he manages to squeeze out of the dying business has to be reinvested immediately into machinery that will be obsolete in a few years. It's a treadmill to nowhere. He calls it, quote, a gravy train to the poorhouse. He's running a business that consumes money. And for a man whose entire philosophy is built on the idea of making money work for him, this is an existential crisis. He needs a different kind of business. He needs a business that doesn't consume capital but produces it. His search leads him to a fellow Omaha native, a brilliant but famously eccentric man named Jack Ringwalt. Ringwalt is the founder and sole owner of a small, peculiar insurance company called National Indemnity. It's not a household name like Allstate or State Farm. National Indemnity is what's known in the trade as a specialty insurer. They don't insure cars for teenagers or homes in the suburbs. They insure the weird stuff. They insure the risks no one else wants to touch. A prize for a hole-in-one at a golf tournament. A circus elephant that might go on a rampage. A fledgling airline's single airplane. Jack Ringwalt is the master of pricing the unpriceable, of turning unusual risk into predictable profit. But by 1967, he's tired. He's in his 60s, he's had health scares, and he's ready to sell. He knows Warren Buffett by reputation, this young financial prodigy who is running a private investment partnership and outperforming the market by leaps and bounds. One day, Buffett's partner, Charlie Munger, suggests they take a look. Buffett agrees. He arranges a meeting with Ringwalt. The meeting itself is the stuff of legend. It lasts all of 15 minutes. There are no teams of lawyers, no investment bankers, no months of due diligence. It's just two brilliant Omaha businessmen sitting in a room. Buffett asks Ringwalt how much he wants for the company. Ringwalt, without a moment's hesitation, names his price. Buffett, equally quickly, says, "We'll take it." The handshake deal is done. The price is $8.6 million. To an outsider, it might have seemed like a fair, if unremarkable, transaction. Buffett was buying a small, profitable insurance business. But Buffett saw something that no one else did. He wasn't just buying a company that made a profit from writing insurance policies. He was buying a bank. A very special kind of bank. One that didn't have to pay interest on its deposits. When he looked at the balance sheet of National Indemnity, he saw the usual assets and liabilities. But one liability in particular made his heart race. It was a line item that represented the premiums that customers had paid for their insurance policies, but for which the company had not yet paid out any claims. This pool of money is called insurance float. And at the time of the acquisition, National Indemnity, a company he just bought for $8.6 million, was sitting on $17.3 million of float. Let that sink in. He paid $8.6 million to acquire a business that came with a $17.3 million pot of other people's money that he now controlled. This wasn't a loan, there were no interest payments, there were no covenants. As long as National Indemnity operated responsibly and priced its risks correctly, that pool of money would remain and even grow for years. It was a permanent, cost-free source of capital. For a man who was fighting tooth and nail in a textile business that devoured capital, this was like finding an oasis in the desert. He had stumbled upon the hidden profit engine. He didn't just buy an insurance company. He bought a money machine that would become the cornerstone of his entire empire. The failing textile mill would soon be just a historical footnote. The real Berkshire Hathaway, the compounding machine we know today, was born in that 15-minute meeting, with the acquisition of a quirky little Omaha insurer and the $17.3 million of float that came with it. The psychological principle that allowed Buffett to see this opportunity where others saw only a boring insurance company is a powerful combination of two cognitive forces, the scarcity heuristic and the power of asymmetric information. Let's first examine scarcity. For the average business owner in 1967, and indeed today, capital is scarce. If you want to grow, you need money. To get money, you typically go to a bank and plead for a loan, subjecting yourself to high interest rates, strict covenants, and the constant threat of foreclosure. Or you sell a piece of your company to investors, diluting your ownership and ceding control. The entire mindset is framed by the scarcity of capital. It's something you have to hunt for, pay dearly for, and beg for. This scarcity heuristic narrows your vision. It forces you down a well-trodden, expensive path. You think in terms of how can I get a loan, not how can I create a system where I don't need a loan. Buffett, even at a young age, had an allergy to this conventional thinking. His experience with the capital-hungry textile mill had taught him the pain of being on the wrong side of the capital equation. He wasn't just looking for a profitable business. He was looking for a solution to his capital scarcity problem. He was looking for a back door, and he found it in float. He realized that an insurance company, if run correctly, inverts the entire banking relationship. Instead of you paying the bank for money, the customers are, in effect, paying you to hold their money. This inversion is a radical conceptual leap that is impossible to make if your mind is trapped by the scarcity heuristic. The second and perhaps more potent principle at play was asymmetric information. This simply means that in a transaction, one party has more or better information than the other. When Warren Buffett sat down with Jack Ringwalt, he understood the true economic value of National Indemnity's business model in a way that perhaps even Ringwalt himself did not fully appreciate. Ringwalt saw his company as a machine for generating underwriting profits. He was proud of his ability to price odd risks and make more in premiums than he paid out in claims. That was his focus. Buffett saw that, of course, but he also saw something much larger. He saw the $17.3 million in float, not as a temporary holding pattern for premiums, but as a permanent and growing pool of investable capital. He knew that this capital, invested wisely in stocks and other businesses over decades, would ultimately dwarf the underwriting profits themselves. He was buying a world-class investor, Jack Ringwalt, but more importantly, he was buying a self-funding investment vehicle. The market at the time certainly didn't understand this. To other investors, National Indemnity was just another small insurance company, and insurance companies were boring, complicated, and opaque. They saw the unearned premiums on the balance sheet as a liability, a debt owed to policyholders, and they valued the company based on its reported earnings, not on the enormous hidden asset of its float. Buffett possessed a superior mental model. He had the knowledge to see value where others saw complexity and risk. This information asymmetry gave him a colossal edge. He wasn't just buying a company for $8.6 million. He was effectively being handed $17.3 million in cash to invest, as he saw fit, plus a profitable business attached. It was one of the greatest financial bargains in history, made possible because he knew something the rest of the world had not yet figured out. He knew the true language of the balance sheet. This insight can be distilled into a practical, repeatable mental model, a blueprint that any investor or entrepreneur can use to find their own hidden profit engines. We can call it the capital source first, acquisition and investment strategy. It completely reframes how you look for opportunities. Step 1 is to reframe the fundamental question. The 99% of investors ask, what business makes the most profit? Or which company has the fastest growing sales? The capital source first strategist asks a different, more powerful set of questions. What business model generates the most low-cost, long-duration capital? Which company gets paid by its customers before it has to deliver the goods or services? The focus shifts from the income statement to the balance sheet and cash flow statement. You are no longer just a profit hunter. You are a capital hunter. Step 2 is to actively hunt for the telltale signs of this capital generation. This means learning a bit of financial statement analysis. You're looking for companies with what is often called negative working capital. In simple terms, this is a situation where a company's current liabilities, the money it owes in the short term, are greater than its current assets used in operations. Specifically, you look for large and growing balances of unearned premiums in an insurer, or deferred revenue in a software or subscription business, or even massive customer deposits. These are all liabilities on the balance sheet, but they represent cash that the company has received up front. Step 3 is to analyze the cost of this capital. This is where the magic happens. For an insurer, the key is the combined ratio, which measures underwriting profitability. If it's below 100%, the insurer is making a profit on its operations, which means the cost of its float is negative. They are literally being paid to hold and invest their customers' money. For a non-insurance business, you'd look at their operating margins. Is the core business that generates this upfront cash profitable? If so, the capital is free. Even if there's a small loss, say an insurer with a combined ratio of 102, that still represents a 2% cost of capital, a rate that a bank would laugh at. Step 4 is to assess the duration of the capital. How long does the company get to keep the money? For a property and casualty insurer writing one-year auto policies, the duration is relatively short. But for a reinsurer that covers long-term liabilities like asbestos claims, the float can have a duration of decades. The longer the duration, the more powerful the compounding effect of investing that capital becomes. A dollar held for 30 years is infinitely more valuable than a dollar held for 1. Finally, step 5, and this is non-negotiable, is to evaluate the stewardship of the capital. All the float in the world is useless, and in fact dangerous, in the hands of a foolish manager. The capital must be allocated by someone with skill, discipline, and an owner-oriented mindset. Is the CEO a brilliant capital allocator, like Buffett, or are they an empire builder who will squander this precious resource on overpriced, egotistical acquisitions? You are looking for the combination, a great business model that generates float and a great manager to invest it. This 5-step blueprint moves you from a passive stock picker to a genuine business analyst, capable of spotting the most durable and powerful business models in the world. To truly appreciate the genius of this approach, we must examine its antithesis, the path walked by 99% of entrepreneurs and investors. This is the growth at all costs trap. The modern business landscape, particularly in the tech sector, glorifies this path. The goal is singular: grow revenue as fast as possible. To achieve this, companies burn through cash at a spectacular rate. They spend lavishly on marketing, sales, and hiring, all in pursuit of a bigger top-line number. Where does this cash come from? It comes from ever more expensive sources. First, they raise a seed round from angel investors, giving up a chunk of their company. Then a Series A, B, and C from venture capitalists, further diluting their ownership at each stage. They become slaves to a cycle of fundraising. Their decisions are no longer guided by profitability or long-term value creation, but by the need to hit the growth metrics required to secure the next round of funding. If they can't raise more private capital, they might turn to debt, taking on high-interest loans that hang like a sword over the company's head. The entire business is built not on a solid foundation of internally generated capital, but on a precarious tower of other people's money, each block of which comes with strings attached and a hefty price tag. They are constantly selling pieces of their future to fund their present. Compare this frantic, desperate scramble for expensive capital with Buffett's serene, patient approach. After buying National Indemnity, he didn't need to sell a single share of Berkshire to fund his growth. He didn't need to ask a bank for a loan. His capital source grew organically as a byproduct of his core business operation. While the growth at all costs entrepreneur is on a treadmill, running faster and faster just to stay in the same place, Buffett was building a flywheel. Each year, the flywheel would spin a little faster, throwing off more and more cash, not because he was selling his company, but because his company was designed from the ground up to be a capital-producing machine. The 99% chase growth and end up with capital providers as their masters. Buffett chased a superior capital source and ended up master of his own universe. The direct financial connection of the National Indemnity acquisition was immediate and profound. It permanently altered the DNA of Berkshire Hathaway's balance sheet, transforming it from a fragile, capital-intensive liability into a powerful, capital-generating asset. Let's visualize a simplified before and after snapshot. Before 1967, Berkshire's balance sheet was a textbook example of a struggling industrial company. On the asset side, you had a huge amount of property, plant, and equipment, the textile looms, the factory buildings. These were illiquid, depreciating assets that required constant maintenance and replacement. The cash balance was perpetually low because every spare dollar had to be plowed back into the failing operation. On the liability side, you would have had significant debt used to finance this equipment. The equity portion of the balance sheet was stagnant or shrinking. Now let's look at the balance sheet the day after the National Indemnity deal closed. Suddenly, the asset side of Berkshire's balance sheet swelled. A huge new line item appears: investments. This is the $17.3 million of float, which is held in cash, bonds, and stocks. This is a liquid appreciating asset, the polar opposite of a textile loom. Simultaneously, on the liabilities side, a new line appears: loss reserves and unearned premiums. This is the accounting representation of the float. To a conventional analyst, this new, massive liability looks terrifying. It makes the company look riskier, but Buffett understood the economic reality. This liability was the very thing that created the asset. It was a productive liability. Unlike debt, it carried no interest expense that would drain the income statement. The entire return generated by the $17.3 million investment portfolio, the dividends, the interest, the capital gains, would flow directly to Berkshire's bottom line, unencumbered by any cost of capital. This single transaction kick-started the explosive growth in Berkshire's book value, the primary metric by which Buffett measured his success. He had found a way to grow the asset side of his balance sheet using an interest-free long-term liability. He had turned the traditional laws of corporate finance on their head. He was no longer just running a business, he was now the chairman of his own private self-funding investment bank. To truly grasp the power of float, we must move beyond the simple idea of holding premiums and delve into the intricate machinery that makes it not just free, but often better than free. This requires us to journey into the high-stakes world of reinsurance and meet the man Warren Buffett considers a singular genius, the architect of Berkshire's modern insurance empire, Ajit Jain. In 1986, Buffett received a call from a friend, Robert Meister, who ran a large insurance brokerage. Meister told him about an extraordinary young man working for him, Ajit Jain. Jain was an Indian engineer, a graduate of the prestigious IIT and Harvard Business School. He had zero experience in the insurance industry, but Meister was convinced he was a prodigy of analytical thought. Intrigued, Buffett invited Jain to Omaha. They talked for hours, not about insurance but about business, risk, and probability. Buffett was floored by the clarity and speed of Jain's mind. He hired him on the spot. He gave him a phone, a checkbook, and a mandate that was as simple as it was terrifying: build a reinsurance business from scratch. Reinsurance is insurance for insurance companies. It deals with massive, complex risks that a single primary insurer cannot handle alone. And Jain immediately plunged into the deepest, most dangerous part of the pool: supercat reinsurance, short for super catastrophe. This is the business of insuring against events of unimaginable scale: a Category 5 hurricane hitting Miami, a massive earthquake in Tokyo, a global pandemic. One of Jain's legendary early deals perfectly illustrates the mechanics of the money machine. In the 1990s, the Lloyd's of London insurance market was on the verge of collapse, crippled by decades of asbestos and pollution claims. These were known as long-tail liabilities, claims from policies written in the 1950s and 60s that were only now coming due, with devastating financial consequences. The entire market was in a panic. No one knew how large the final bill would be. It was a black hole of uncertainty. While every other insurer was running for the hills, Ajit Jain ran toward the fire. He, on behalf of Berkshire, offered a unique type of reinsurance policy. For a very large fixed premium paid up front, Berkshire would assume all of Lloyd's, past asbestos liabilities, forever. It was an audacious move. The world's financial press was stunned. They saw it as Buffett and Jain betting the farm on a risk that was fundamentally unknowable. But Jain had done the work. He and his small team had analyzed the problem with a level of analytical rigor that no one else could match. He calculated the probabilities, the potential range of outcomes, and he named a price. He demanded a premium of several $1 billion, paid immediately, in cash. Lloyd's, desperate to excise this cancer from their books, agreed. Instantly, Berkshire Hathaway's float ballooned by billions of dollars. This wasn't one-year auto insurance float. This was the highest quality, longest duration float imaginable. The claims for these liabilities would be paid out slowly, over many decades. This gave Buffett a multi-billion-dollar sum of money that he could invest for 30, 40, or even 50 years before the corresponding claims would have to be paid. And the best part? Given the price Jain charged, he was highly confident that the premium received would be more than enough to cover all future claims and expenses. The underwriting was designed to be profitable. Berkshire didn't just get a free loan for half a century, they were paid a handsome fee to accept the loan in the first place. This is the money machine at its most powerful. The underlying psychological principle that allows this machine to function is a deep-seated human and corporate cognitive bias known as ambiguity aversion. People hate uncertainty. We are wired to prefer a known risk over an unknown, ambiguous one. If you offer someone a choice between a bet with a 50% chance of winning $100 and a bet where the chance of winning $100 is unknown, most people will choose the first option, even though the second could theoretically have a much higher probability of success. We shy away from the ambiguous. The corporate world is even more allergic to ambiguity. A CEO and a board of directors cannot go to their shareholders and say, "We have a massive, open-ended asbestos liability on our books, and we have no idea what the final cost will be." That kind of uncertainty spooks investors, tanks stock prices, and gets executives fired. They are powerfully motivated to remove that ambiguity from their financial statements, to quantify the unquantifiable, to turn a scary, open-ended problem into a single, fixed number. They will pay a huge premium to achieve this certainty. This is where Ajit Jain and Berkshire Hathaway step in. Their unique talent is the ability to price ambiguity. They are masters of turning a vague, terrifying fear, like asbestos litigation, into a concrete set of probabilities and a rational price. They exploit the ambiguity aversion of their clients. The client, whether it's Lloyd's of London or another major corporation, is paying Berkshire not just to assume a financial risk, but to assume a psychological one. They are paying for peace of mind. They are paying to make the ambiguity disappear. Berkshire, with its fortress-like balance sheet and its long-term perspective, is uniquely positioned to be the recipient of this, quote, ambiguity premium. They have the financial strength to withstand worst-case scenarios and the intellectual rigor to not overpay for risk. This cognitive bias in the rest of the world is the very source of their competitive advantage. They have created a multi-billion-dollar business by being the one party in the room that is comfortable with and expert at navigating the fog of uncertainty. This sophisticated approach can be simplified into an actionable mental model for any investor evaluating an insurance company, the underwriting profitability filter. This is a crucial tool for financial statement analysis that separates the disciplined, value-creating insurers from the reckless, value-destroying ones. Step 1 is to find the company's combined ratio. This is the single most important metric in the insurance business. You can usually find it in a company's annual report or investor presentations. The formula is simple. It's incurred losses plus expenses divided by the earned premium. In plain English, it's what the company pays out in claims and operating costs, divided by what it takes in from the policies it writes. Step 2 is to understand the magic number, 100. If the combined ratio is less than 100, the company has an underwriting profit. For every dollar of premium they took in, they paid out less than $1 in claims and expenses. This means their float is better than free. They are being paid to hold their customers' money. If the combined ratio is exactly 100, the float is free. If the combined ratio is, say, 102, it means the company has a 2% underwriting loss. This isn't necessarily a disaster. It means they are effectively paying 2% interest on the capital they get from their float. In a world of 5% or 8% corporate bond rates, a 2% cost of capital is still a massive competitive advantage. But anything consistently over 105 or 106 should be a major red flag. Step 3 is to analyze the consistency of this ratio over time. Any insurer can have one lucky year with no hurricanes. But can they maintain a combined ratio at or near 100 for 5, 10, or even 20 years? Look for a long-term track record. Consistency is the hallmark of discipline and skill. A volatile combined ratio suggests a company that is either bad at pricing risk or is chasing market share at the expense of profitability. Step 4 is to deconstruct the ratio. What is driving the profitability? Is it low expenses? Geico, another Berkshire subsidiary, wins because its direct-to-consumer model cuts out the agent commissions, leading to a structural cost advantage. Or is it superior risk assessment and pricing, like Ajit Jain's reinsurance division? Understanding the stratagem behind the numbers gives you a much deeper insight into the durability of the company's advantage. By applying this simple filter, you can quickly sift through the insurance industry and identify the rare gems. The companies that treat underwriting as a sacred discipline, thereby ensuring their float is a perpetual, low-cost, or no-cost source of fuel for portfolio growth. To fully grasp the importance of this discipline, we must look at the disastrous path of the 99% in the insurance world, the siren song of cash flow underwriting. This is one of the most common and destructive traps in the industry. It begins with an obsession for growth. An insurance CEO, judged by Wall Street on the growth of their premium volume, might be tempted to win business at any cost. They start lowering their prices, offering coverage for less than the actuarially sound rate, just to get the premium dollars in the door. They are writing unprofitable policies, guaranteeing an underwriting loss. Their thinking is fatally flawed. They tell themselves, "It's okay if we lose a little money on the underwriting, because we'll get all this new float, and our brilliant investment team will make up the difference in the stock market." This works for a while. As long as the market is going up and there are no major catastrophes, the company looks like it's growing, the stock price might even rise. But the company is a ticking time bomb. They have built their house on a foundation of sand. The insurance industry is cyclical. Inevitably, a hard market arrives. Investment returns fall, or a series of major disasters like a Hurricane Andrew or the 9/11 attacks occurs. Suddenly, the company is hit with a double whammy. Their investment income shrivels up at the exact same moment their claims are skyrocketing. The underwriting losses, which were once a manageable trickle, become a torrent. Because they were undisciplined in their pricing, their reserves are inadequate. They are forced to sell their investment portfolio at depressed prices to pay claims, locking in permanent losses. The company spirals into insolvency and collapses. This isn't a theoretical risk. This exact scenario played out repeatedly in the insurance cycles of the 1970s and 1980s, wiping out dozens of companies that fell for the allure of cash flow underwriting. They forgot the cardinal rule that Buffett and Jane live by: float is only a treasure if it is obtained at a rational cost. Recklessly pursuing premiums without underwriting discipline doesn't create a hidden profit engine, it creates a hidden time bomb. The direct financial connection between disciplined underwriting and shareholder wealth is undeniable and mathematically elegant. A combined ratio below 100 has a powerful, twofold effect on the financial statements. First, it directly impacts the income statement. When underwriting is profitable, the revenues, premiums earned, are greater than the cost of goods sold, claims and expenses. This profit flows directly to the bottom line, increasing the company's net income. This reported profit can then be added to retained earnings on the balance sheet, which directly increases the company's book value per share, a key driver of long-term stock performance. This is the simple, direct profit from the insurance operation itself. But the second effect is even more profound. It relates to the quality of the balance sheet. Every dollar of new premium written, whether profitably or not, adds to the float. This float appears on the balance sheet in two places simultaneously. On the liabilities side, it increases unearned premiums. On the asset side, it increases cash and investments. When the underwriting is profitable, you are essentially getting paid to grow both sides of your balance sheet. Think about the miracle of this. A normal company, say a manufacturer, wants to grow its assets, build a new factory. To do this, it must take on debt, which adds an interest expense that drains the income statement, or it must issue new shares, which dilutes existing owners. Berkshire, through its profitable insurance operations, can grow its assets, its massive portfolio of stocks and bonds, without any of these downsides. The growth is funded by a non-interest-bearing liability generated by a profitable core business. This means that 100% of the return from that growing investment portfolio accrues to the benefit of the shareholders. There is no slice for the bankers, no dilution for new partners. This is the ultimate source of market alpha. It's a structural advantage that allows a company to compound its capital at a much higher rate for a much longer period than a business funded by conventional means. It is the perfect financial machine. The year is 1999. The stock market is in a state of collective mania. It's the height of the dot-com bubble. Companies with no profits, no revenues, and in some cases no finished products are going public and seeing their valuations soar to billions of dollars overnight. The narrative is intoxicating. The internet has changed everything. Old valuation metrics are obsolete, and this time, it's different. Meanwhile, in Omaha, Warren Buffett is being openly mocked. Berkshire Hathaway, his masterpiece of compounding, is being left in the dust. While the Nasdaq is rocketing up by over 85% in a single year, Berkshire stock is actually falling. Barron's, the influential financial newspaper, runs a cover story with the headline, "What's Wrong, Warren?" The article is brutal. It declares him a relic, a man out of touch with the new economy. It suggests his value investing principles are dead, a quaint philosophy for a bygone era. Analysts and television pundits pile on. Buffett is too old, too cautious, too stuck in his ways of buying boring companies that make things like candy, furniture, and insurance. The pressure is immense. Shareholders are grumbling, his own friends are questioning him. Yet, Buffett does not waver. He continues to write in his annual letters that he doesn't understand the valuations of these new tech companies, and that he will not play a game where he doesn't understand the rules. He refuses to chase the herd. He sits patiently on a mountain of cash, a significant portion of which has been generated by the steady, unglamorous float from his insurance operations. Then, in March of 2000, the bubble bursts. The Nasdaq, which had peaked above 5,000, begins a catastrophic collapse. Over the next 2 years, it will fall by nearly 80%. Trillions of dollars of speculative wealth are vaporized. The new economy darlings, Pets.com, Webvan, eToys, go bankrupt. The narrative that had seemed so invincible is shattered. And what of Berkshire Hathaway, the dinosaur? As the market crashes, Berkshire stock begins to climb. The world suddenly rediscovers the beauty of real earnings, strong balance sheets, and rational management. More importantly, Buffett, with his billions of dollars in float-generated cash, is now the only person with a loaded gun in a room full of people who have run out of ammunition. He becomes the lender and investor of last resort, able to deploy his capital into distressed but fundamentally sound businesses at bargain basement prices. He provides financing to companies on incredibly favorable terms, scooping up assets that will generate billions in profits for decades to come. The very thing he was mocked for, his patience, his discipline, his reliance on the boring, cash-generating power of float, became his ultimate weapon. The dot-com bubble is the perfect real-world anecdote for the psychology of why Wall Street consistently misunderstands the power of float. The two dominant cognitive biases at play here are herd bias and the narrative fallacy. Herd bias is our innate primal instinct to follow the crowd. It's an evolutionary leftover from a time when straying from the tribe meant being eaten by a lion. In financial markets, this translates into a powerful fear of being left behind. When a stock or a sector is soaring, professional money managers, whose performance is judged quarterly, face immense pressure to participate. If they don't own the hot tech stocks and the bubble keeps inflating, they will underperform their peers, lose clients, and potentially their jobs. It is often professionally safer to be wrong with the crowd than to be right alone. This creates a feedback loop where rising prices beget more buying, completely detached from underlying fundamentals. Buffett's ability to resist this pull is legendary. He is psychologically capable of standing apart from the herd, even when it means looking foolish for an extended period. The second bias is the narrative fallacy, a concept popularized by Nassim Taleb. Our brains are not designed to process raw, complex data. We crave simple, coherent stories to make sense of the world. In 1999, the story of "The Internet Changes Everything" was simple, compelling, and easy to grasp. It was a story about the future, about infinite growth, about a paradigm shift. The story of Berkshire Hathaway, in contrast, was complex and boring. To understand it, you had to read dense financial statements, understand the arcane mathematics of insurance underwriting, and appreciate the subtle, long-term power of capital allocation. The simple, exciting story will almost always win the battle for attention over the complex, boring one, especially in the short term. Wall Street is a storytelling machine. It sells narratives, and the narrative of float is simply not a sexy story. This combination of herd following and a preference for simple narratives creates a systemic blindness to the durable, long-term advantages of a business like Berkshire. It leads to periods of massive mispricing, where the market undervalues the substance of float and overvalues the story of speculative growth, creating generational buying opportunities for those who can see through the psychological fog. To arm yourself against this psychological fog, you need a mental model that allows you to see the balance sheet differently than everyone else. you need to learn the liability as an asset inversion. This is a deliberate, conscious process of retraining your brain to interpret financial statements not just by their accounting labels but by their economic substance. Step 1 is to actively hunt for float-like liabilities on a company's balance sheet. These are liabilities that represent cash received from customers up front. The most obvious is unearned premiums or loss reserves at an insurance company. But you should also look for deferred revenue, unearned revenue, or customer deposits. A large and growing accounts payable balance relative to accounts receivable can also be a sign of a company with strong bargaining power over its suppliers, which functions as a form of float. Step 2 is to ask 3 critical questions about these liabilities. First, does the company get the cash before times it has to deliver the product or service? The answer must be a resounding yes. This is the core of the float concept. Second, what is the duration of this cash? How long, on average, does the company get to hold the money before the liability is settled? Longer is always better, as it gives more time for the invested capital to compound. Third, what is the cost of this funding? Is the underlying business that generates this cash profitable? If so, the capital is free or better than free. Step 3 is the crucial inversion. You must consciously train your mind to see that large, growing deferred revenue liability not as a scary debt that needs to be paid back, but as a proxy for a massive, interest-free loan from the company's own customers. It is a sign of a powerful business model. It's an asset in disguise. Step 4 is to solidify this inversion by comparing it to a normal company. Pull up the balance sheet of a capital-intensive airline or an old-school car manufacturer. Look at the massive amounts of long-term debt on their balance sheet. Then go to their income statement and see the huge interest expense line item, a constant drag on their profits. Now, toggle back to the balance sheet of a well-run insurer or a dominant software-as-a-service company. See the absence of that traditional debt and interest expense. See how their investment portfolio is funded by their customers instead of by Wall Street banks. This side-by-side comparison makes the advantage visceral and unforgettable. This advanced investing concept, when applied, will allow you to see the hidden strength in companies that others view as complex or risky. The antithesis to this deep, analytical approach is the path followed by the 99%, the obsession with simplistic, surface-level metrics, particularly GAAP earnings and the price-to-earnings PE ratio. For most retail investors, and frankly for many so-called professional analysts, stock analysis begins and ends with the PE ratio. They look up a company's stock, see a PE of 15 and declare it cheap. They see another with a PE of 50 and declare it expensive. This is a dangerously incomplete way to think about value, especially for a company with a float-based business model. The problem is that GAAP, or generally accepted accounting principles, are a notoriously poor guide to economic reality. For an insurance company, GAAP earnings can be incredibly misleading. They are subject to all sorts of estimates and assumptions about future losses that can obscure the true performance of the business. More importantly, the single greatest value-creating activity in a company like Berkshire, the profitable growth of its float, is not explicitly captured in GAAP earnings. A Berkshire subsidiary could have a break-even year in terms of GAAP profit, but if it added $10 billion of long-duration, zero-cost float to the balance sheet, its intrinsic value has soared. That $10 billion is now a new army of capital that Warren Buffett can deploy to generate investment returns for decades. The PE ratio completely misses this. It only sees the break-even accounting profit and would lead you to conclude that nothing of value was created. An investor who relies solely on these simple metrics will forever be blind to the true source of value creation in these elite business models. They will look at Berkshire during the dot-com bubble, see its low-growth earnings, and sell it to buy a tech company with no earnings at all, congratulating themselves on their forward-thinking approach right up until the moment they are wiped out. The mastery of float requires you to go beyond the headlines, beyond the simple ratios, and understand the economic engine humming silently beneath the surface of the accounting statements. The direct financial connection between float and long-term value creation can be found by understanding how it fundamentally changes the composition of a company's balance sheet and the source of its returns. Float does not appear as a single convenient line item labeled float. It is an economic concept whose presence must be inferred from the relationship between assets and liabilities. The key insight is this: on Berkshire's balance sheet, you see a colossal asset called investments, hundreds of billions of dollars in stocks like Apple and Coca-Cola, and U.S. Treasury bills. In a normal company, an asset of this size would have to be funded by one of two sources: either a corresponding liability of debt or a massive shareholders' equity account built up from issuing stock or retaining decades of earnings. If it were funded by debt, there would be a huge interest expense on the income statement, reducing the net return from the investments. If it were funded by equity, the returns would be spread across a much larger number of shares, reducing the per-share value growth. Berkshire is different. Its massive investment portfolio is primarily funded by its insurance liabilities. The float from Geico, National Indemnity, and Ajit James' reinsurance empire provides the capital. This means there is no interest expense dragging down the returns. It means there is no dilution from issuing new stock to raise capital. The entire pre-tax return from that hundreds of billions of dollars investment portfolio, every dividend check from Apple, every capital gain from Coca-Cola, is an economic gain that belongs entirely to the existing shareholders. This creates a level of capital efficiency that is almost impossible to replicate. It is a built-in, structural source of market alpha. It's the secret sauce that allows Berkshire to consistently beat the S&P 500 over the long run. The company's returns are not just from its operating businesses. They are massively amplified by the returns on an investment portfolio funded with free, permanent capital. This is the tangible, quantifiable financial advantage that flows directly from understanding and harnessing the power of float. The principle of using other people's money to fund your growth is not limited to the insurance industry. The concept of float, in its essence, is about getting paid before you deliver a product or service. This customer-funded business model appears in various forms across the economic landscape, and some of the greatest business fortunes have been built on top of it. One of the most brilliant examples comes from another chapter in Warren Buffett's own career: his transformative investment in American Express during the Salad Oil scandal of 1963. American Express in the early 60s was a blue-chip company, a pillar of the financial establishment. One of its smaller, less glamorous divisions was in field warehousing. They would inspect a company's inventory, certify its existence, and then issue receipts against which the company could borrow money. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino De Angelis. De Angelis had managed to secure massive loans using barrels of salad oil as collateral, certified by American Express. The problem was, the barrels were mostly filled with seawater, with just a thin layer of oil on top. When the fraud was discovered, Allied Crude collapsed, leaving its lenders with worthless collateral. Wall Street panicked. The lenders sued American Express, claiming they were liable for the fraudulent certifications. The potential liabilities were enormous, far exceeding the company's net worth. American Express stock plummeted by more than 50%. The consensus was that the company was doomed. But a young Warren Buffett, then running his small investment partnership in Omaha, was skeptical of the panic. He decided to do his own research, not by reading Wall Street reports, but by observing reality. He went to restaurants and travel agencies. He talked to merchants. He wanted to know if the scandal, which was front-page news in the financial world, had actually damaged the core of American Express's business. What he found was that customers were still using their American Express cards. They were still buying travelers' checks with confidence. The merchants still proudly displayed the American Express Accepted Here sign. The scandal was a fire in a remote warehouse, but the main castle, the brand and its relationship with its customers, was untouched. He realized that the fundamental business model was intact and incredibly powerful. And what was that model? It was a float-generating machine. Think about travelers' checks. a huge business for Amex at the time. A customer gives American Express $100 in cash. In return, they get a piece of paper. That customer might not use that traveler's check for weeks, months, or even years. In the meantime, American Express gets to hold and invest that $100, interest-free. Multiply that by millions of customers, and you have a massive pool of float. The charge card business worked similarly. A cardholder makes a purchase. The merchant has to wait, sometimes for several weeks, to get paid by American Express. But American Express gets the money from its cardholder on a regular monthly cycle. That gap between when the money is used and when it's paid out to merchants creates another enormous pool of float. Buffett saw that this powerful, durable engine of free money was being offered at a clearance price because the market was fixated on a one-time, albeit large, problem. He famously invested 40% of his partnership's entire capital into American Express stock. Within a few years, the stock had recovered and soared, netting him a fortune. It was a classic Buffett investment, finding a wonderful business with a hidden float engine that was temporarily obscured by fear and uncertainty. The psychological principle that blinded Wall Street during the Salad Oil scandal is known as the focusing illusion. This is our cognitive tendency to place too much importance on one single aspect of an event or decision, causing us to misjudge the whole picture. In 1963, the entire financial community was focusing on the Salad Oil. The scandal was the only thing they could see. The headlines, the lawsuits, the potential liabilities. It was a bright, flashing warning light that consumed all of their attention. This intense focus caused them to completely ignore the far more important, far more durable reality. The unshakable power of the American Express brand and the loyalty it commanded. Brand loyalty is a powerful psychological moat that protects a float-generating business model. Why were people willing to hand over their cash for American Express travelers' checks? Trust. The brand represented security and reliability around the world. Why did merchants tolerate waiting for weeks to be paid by Amex? Because they had to. Access to the affluent, high-spending American Express cardholder was essential for their business. The brand gave American Express immense bargaining power over both its customers and its suppliers, the merchants. This power is what allowed the float to be generated so consistently and on such a large scale. Buffett, by going out and talking to real people in the real world, was able to break free from the focusing illusion that had paralyzed Wall Street. He saw that the scandal was a temporary storm, but the brand was a bedrock foundation. He chose to focus on the durable, underlying business model rather than the sensational, temporary headline. This ability to correctly identify what truly matters and to ignore the distracting noise is a hallmark of a master investor. Wall Street focused on the illusion of risk. Buffett focused on the reality of the float engine. We can generalize this insight into a practical tool for finding these float-like businesses everywhere, not just in finance. We'll call it the Customer-Funded Business Scorecard. It's a series of checks to run on any company to see if it possesses this hidden advantage. Step 1 is to analyze the company's cash conversion cycle, or CCC. This sounds complicated, but it's a simple and incredibly powerful metric. It measures the time, in days, it takes for a company to convert its investments in inventory and other resources into cash from sales. The formula is days inventory outstanding, how long stuff sits on the shelf, plus days sales outstanding, how long it takes to get paid by customers, minus days payable outstanding, how long you take to pay your suppliers. Most companies have a positive CCC, meaning they have to fund their operations with cash for 30, 60, or 90 days. But a company with a negative CCC is a thing of beauty. It means their customers pay them before they have to pay their suppliers. They are being funded by their operations. This is a clear sign of a float-like business model. Step 2 is to hunt for deferred revenue on the balance sheet. Scan the liabilities section for a line item called deferred revenue, or unearned revenue. This is the accounting term for cash received from customers for services that have not yet been delivered. It's the purest form of float outside of insurance. Think of a software-as-a-service company that sells an annual subscription. They get 12 months of cash on day 1, but they only deliver the service 1 month at a time. That 11 months of cash is pure float they can use to fund their growth. Step 3 is to analyze loyalty programs and other forms of customer prepayments. Think of Starbucks. Millions of customers have loaded money onto their Starbucks cards and the mobile app. That collective balance, which is often in the billions of dollars, is a massive, interest-free loan to the company. It's float. The same is true for airline loyalty points or Costco's annual membership fees. Customers pay a fee upfront for the privilege of shopping there for a year. That pool of membership fees is billions of dollars of zero-cost capital. Step 4 is to assess the customer's switching costs. How difficult or painful would it be for the customer to leave? For a SaaS product that is deeply integrated into a client's daily workflow, the switching costs are immense. This makes their deferred revenue stable and predictable. The higher the switching costs, the more permanent and valuable the float becomes. This scorecard provides a systematic way for any entrepreneur or retail investor to look beyond the obvious and identify businesses that are quietly funding their own growth with their customers' cash. The opposite of these elegant, self-funding models is the brutal reality for the 99% of businesses, the capital-intensive grinder. Let's paint a picture of a typical manufacturing or retail company. Their journey begins by spending a huge amount of cash up front to build a factory or stock a store with inventory. That cash is now tied up, sitting in a warehouse as boxes of product. This is cash that isn't earning a return. Then they sell the product, often on credit, to a large corporate customer. They record a sale, but they don't get the cash. Instead, they get an account receivable. They now have to wait 30, 60, or even 90 days to actually collect the money. Meanwhile, the suppliers who provided them with the raw materials are demanding to be paid in 30 days. This creates a painful cash flow gap. They have paid their suppliers long before they get paid by their customers. This positive cash conversion cycle is a constant drain on the company. It acts as a financial treadmill. The faster the company grows, the more cash it needs to fund this gap in working capital. Growth paradoxically makes the cash problem worse. To survive, they must constantly seek outside financing. They take on expensive bank debt, which eats into their profits through interest payments. They sell equity, which dilutes the ownership of the founders. They are perpetually at the mercy of their capital providers. Their strategic decisions are dictated not by long-term opportunity, but by the short-term need to manage their cash crunch. This is the default state for most businesses. It's a constant, grinding struggle for financial survival. It stands in stark, brutal contrast to the serene, self-propelled growth of a business built on the principle of float. For a modern non-insurance example of the direct financial connection between a float-like business model and staggering value creation, look no further than Amazon. While Amazon is known for its e-commerce dominance and cloud computing prowess with AWS, at its core, it is a master of the cash conversion cycle. When you buy a product on Amazon, you pay for it instantly with your credit card. Amazon receives that cash within a day or two. Now, consider the seller of that product. If it's a third-party seller on Amazon's marketplace, Amazon holds their money for a period of time before remitting it. If it's a product Amazon sells itself, they likely bought it from a supplier on terms. They might not have to pay that supplier for 60, 90, or even more days. This gap between getting paid instantly by the customer and paying their suppliers much later creates a massive permanent pool of float. Their cash conversion cycle has been deeply negative for most of their history. What does this mean in practice? It means that as Amazon's sales grew, their pool of free cash grew right alongside it. They didn't need to borrow money to fund their inventory or expansion. Their growth was literally self-funding. This river of operational float provided the capital that fueled their relentless innovation. It funded the development of the Kindle. It funded the global build-out of their fulfillment centers. Crucially, it funded the creation and scaling of Amazon Web Services, which started as an internal project and is now one of the most profitable businesses on the planet. This direct link is clear. An operational advantage. The negative cash conversion cycle generated a massive financial advantage in the form of interest-free capital. That capital was then brilliantly allocated by a visionary leader, Jeff Bezos, into new, high-growth ventures. This is the float principle in action in the 21st century, demonstrating how a subtle operational design can directly translate into trillions of dollars of market value and spectacular capital gains for shareholders. The ultimate expression of the float principle is not just in its acquisition or its mechanics, but in its role as the perpetual fuel for a compounding machine. To understand this final highest level of mastery, we must travel back to 1972 and examine one of the most important acquisitions in Berkshire Hathaway's history, the purchase of See's Candies. On the surface, it seemed like a strange move. See's was a family-owned, West Coast-based chocolate company. It was a wonderful, beloved brand, but it was a small, slow-growth business. Buffett and his partner, Charlie Munger, paid $25 million for it. At the time, Buffett himself thought the price was a little high. The company was only earning a couple of $1 million a year before tax. His instinct, honed by his early cigar butt investing days, was to buy statistically cheap, mediocre businesses. It was Charlie Munger who pushed him to change his perspective. Munger argued that it was far better to buy a wonderful business at a fair price than a fair business at a wonderful price. And See's was a truly wonderful business. It had a powerful brand that commanded pricing power. Customers were fiercely loyal. But most importantly, it had extraordinary economics. The business required very little capital to run. A customer would walk into a store, pay cash for a box of chocolates, and walk out. The company got its money instantly. It didn't need to invest in massive amounts of research and development or expensive new factories. As a result, See's Candies gushed free cash flow. The acquisition of See's marked a critical evolution in Buffett's thinking. He began to see the Berkshire Hathaway empire as a two-part system. On one side, you had the insurance operations, the great float generators. These businesses would periodically take in huge, lump sums of capital, like the billions from the Lloyd's of London deal. This was the lumpy capital. On the other side, you now had businesses like See's Candies. See's wouldn't provide billions in float, but every single year, like clockwork, it would produce a predictable, steady stream of cash that it did not need for its own operations. This was the smooth capital. The genius was in combining these two. The ever-growing insurance float was the primary engine, providing the massive firepower for large acquisitions and stock market investments. The cash flow from wholly owned businesses like See's was the reliable supplementary fuel, a river of money that could be counted on, year in and year out, to be redeployed elsewhere. This created the Berkshire Hathaway flywheel. The insurance businesses generate low-cost float. That float is used to buy wonderful operating businesses like See's Candies. See's Candies then produces its own steady stream of cash. That cash, combined with even more new float from the growing insurance operations, is then used to buy even more operating businesses or stocks. Each component reinforces the other. The float buys the businesses, and the businesses produce cash that swells the capital base, which in turn allows the insurance side to take on even larger risks, which generates even more float. It is a self-reinforcing, ever-accelerating cycle of wealth creation. See's was the first gear in this new part of the machine, the prototype for the kind of business Buffett would hunt for over the next 50 years. This beautiful, self-reinforcing system is a perfect illustration of a mental model championed by Charlie Munger, the Lollapalooza effect. This is Munger's term for an outcome that is driven not by one single factor, but by a confluence of multiple factors all acting in the same direction, creating a result that is far more powerful than the sum of its parts. Berkshire Hathaway is perhaps the greatest Lollapalooza effect in business history. Let's break down the individual forces that combine to create this extreme outcome. First, you have the structural advantage of low-cost, long-duration float from a disciplined insurance operation. This is the foundational fuel source, the unfair advantage we have been discussing. Second, you have the rational, patient, and supremely skilled capital allocation of Warren Buffett and Charlie Munger. The fuel is useless without a brilliant engine to convert it into power. Their decisions on where to invest that float are the second critical factor. Third, you have the acquisition of high-return, low-capital-intensity operating businesses. Buying companies like See's Candies, which generate more cash than they consume, adds another independent source of capital to the flywheel. Fourth, you have the policy of reinvesting nearly all earnings. Berkshire historically has not paid a dividend. Every dollar of profit, whether from the insurance operations, the investment portfolio, or the operating businesses, is retained and put back to work, allowing the power of compounding to work its magic uninterrupted. Fifth, you have a decentralized corporate structure that allows the managers of the operating businesses to focus on their jobs without corporate bureaucracy, maximizing their efficiency. When you combine all of these factors, you don't get a simple additive result, you get a multiplicative, exponential outcome. The feedback loops between the components create a system that grows stronger and larger with each passing year. It's an unstoppable force, a financial snowball rolling downhill, picking up more snow and gaining more momentum with every rotation. This Lollapalooza effect can be codified into a final blueprint for investors and entrepreneurs seeking to build lasting value. We can call it the permanent capital compounding machine blueprint. It has 4 essential components. Step 1 is the fuel source. You must have a business at the core that generates low-cost, long-duration, and preferably growing capital. This can be insurance float, deferred revenue from subscriptions, a negative cash conversion cycle, or any other form of customer-funded model. This is the non-negotiable starting point. Without this cheap, reliable fuel, the machine cannot run. Step 2 is the allocation engine. This fuel must be controlled by a rational, patient, and skilled capital allocator. For a retail investor, this means investing in companies that are led by such people. You must study the CEO, read their shareholder letters. Look at their track record of acquisitions and investments. Are they focused on creating long-term per-share value, or are they chasing short-term headlines and their own egos? Finding a brilliant allocator is just as important as finding a brilliant business model. Step 3 is the portfolio of high-return outlets. The capital generated by the fuel source needs places to be invested where it can compound at a high rate of return over a long period. This could be a portfolio of publicly traded stocks bought at attractive prices, or it could be wholly owned private businesses with durable competitive advantages, the so-called moats. The key is that these outlets must be able to absorb large amounts of capital and generate returns that are well above the cost of that capital. Step 4 is the reinvestment mandate. The machine must be a closed loop. The earnings, dividends, and cash flow generated by the investment outlets must be retained within the structure and reinvested back into more high-return opportunities. Paying out a large portion of earnings as dividends breaks the compounding cycle. The goal is to keep the capital working, to let the snowball keep rolling and growing. A business that combines these 4 components, a great fuel source, a great allocator, great investment outlets, and a reinvestment mandate, is the ultimate financial fortress, a machine designed for the express purpose of achieving long-term financial freedom. To truly appreciate the rarity and power of this model, we must contrast it with the all-too-common path of the 99% of corporate leaders, the diversification empire builder. This is the CEO who, after achieving success in their core business, gets flush with cash and ego. Instead of returning the excess cash to shareholders or reinvesting it rationally, they get a burning desire to build a larger empire. They start making acquisitions, often in industries they know nothing about. They buy the trendy company of the moment, paying a huge premium because it's in a hot sector. They justify the purchase with vague talk of synergies that rarely materialize. They issue massive amounts of new stock to fund these deals, diluting the ownership of the very shareholders they are supposed to be serving. Their motivation is not the rational calculation of return on invested capital. It is the egotistical desire to be on the cover of magazines, to attend high-profile conferences, and to preside over a sprawling, complex conglomerate. The result, far more often than not, is what Peter Lynch famously termed diversification, the process of buying businesses that are so unrelated and poorly integrated that they actually destroy shareholder value. A historical example is the conglomerate craze of the 1960s, led by companies like ITT under Harold Janine. ITT bought hundreds of companies in completely unrelated fields: hotels, rental cars, bakeries, insurance. The result was an unmanageable mess that eventually collapsed under its own weight and complexity. The diversification empire builder is the polar opposite of the rational capital allocator. They are a capital destroyer. They take the precious fuel generated by a good core business and pour it onto a bonfire of ego and bad ideas, leaving shareholders with nothing but the ashes. The direct financial connection between the Berkshire flywheel model and its staggering long-term performance can be visualized with a simplified, decade-by-decade model of its growth. Imagine in year zero, Berkshire starts with just $20 million in insurance float. If Buffett invests this at a modest 10% annual return, it generates $2 million in investment income. But that's not all. In year one, let's say the growing insurance operations add another $5 million in new, profitable float. The total capital base is now the original $20 million, plus the $2 million in investment income, plus the $5 million in new float, for a total of $27 million. Now that entire $27 million is invested at 10%, generating $2.7 million in income for the next year. In year two, let's say they add another $6 million in new float. The capital base is now $27 million, plus $2.7 million in income, plus the $6 million in new float, totaling $35.7 million. Do you see what is happening? The growth is not linear, it's exponential. The capital base is growing from two sources simultaneously: the investment returns on the existing pool of float, and the addition of new float from the underlying business. It's this dual-engine growth that creates the explosive, long-term trajectory of Berkshire's book value and, ultimately, its stock price. When you extrapolate this simple model over 50 years, and you factor in the addition of wholly owned businesses that contribute their own streams of cash to the pot, the numbers become astronomical. The initial $20 million in float becomes hundreds of billions. The initial investment income of $2 million becomes tens of billions. This is the magic of compounding, supercharged by a constant infusion of new, low-cost capital. This is the ultimate financial manifestation of the float principle. It is the master key that unlocks the kind of generational wealth that changes not just a person's life, but the entire landscape of finance itself. You have made it to the end of this journey, and your perspective on the world of business and investing should now be permanently altered. You no longer see a balance sheet as a static document. You see it as a dynamic engine. You understand that beneath the complexity of insurance liabilities and deferred revenues lies the market's free money, a hidden river of capital that can fuel a business indefinitely, creating an almost unfair advantage for those who know how to find it and harness its power. You now possess a mental tool that allows you to separate the truly elite businesses from the merely good ones. But mastering the engine is only the first step. A powerful engine is useless without a brilliant driver and a flawless chassis. The what, the float, is only powerful when combined with the who and the how. Who is the capital allocator with the discipline to deploy this capital intelligently, resisting the siren song of ego and empire building? And how do they build an entire corporate structure, a fortress of mutually reinforcing businesses around this central engine, creating a system so durable it can withstand any economic storm? The video that is about to play on your screen is the next piece of that map. It moves beyond the fuel source and into the architecture of the compounding machine itself. It is the link that connects the engine of float to the principles of building an impenetrable business moat, ensuring that the profits generated by this hidden engine are protected for decades to come. Many will stop here, content with knowing the secret of the engine. But for those of you on a genuine path to financial freedom, for those building a true arsenal of executive decision-making, the journey continues. Completing the map is not a passive act. It's a choice. The next step in your ascent is right there on the screen. Click and continue the climb.